We've got Ramaswamy Narayanan, the CMD at GIC Re, joining in on the show right now to talk about their quarterly performance. Mr. Ramaswamy, great to have you on the show. Let's firstly talk about your combined ratio, because we've seen this rising industry-wide. Some health insurers attributed this to higher claims ratio as well. Tell me, which segment for you is adding pressure on your combined ratios?
Well, multiple areas. I think property has been a bit of a worry because that's an area where catastrophic losses do happen. Unfortunately, we've also seen the pricing on the direct side fall in the property segment. So that's been a case of worry for us. But overall, I think we have done better compared to the market. Our combined is actually, when you compare it with the previous period of 39-23, we've actually shaved off about 6% on the combined ratio. So we're very confident about doing better. Normally, this quarter and the next quarter is an area where our loss ratios can go up because of the provisioning that we do. See, for international as well as domestic markets, these are the times when you get catastrophic losses like floods and wind events happening. So normally we do expect combines to go up. But overall, when we look at our book now, we're very confident about doing much better than last year.
So at what level your combined ratio will settle? I mean, do you see going below 100 in near future? Because that's where you start making money with your operations.
Well, sir, I would look at it two ways. To immediately answer your first question, in the immediate future, in the next couple of years, we don't expect it to go down to 100 levels because it will take time. It's a journey. It's not something that will happen overnight. Uh, Last year, we finished with about 112. We are currently at around 111 for the half year. Hopefully, this year we should, come into the 107, 108 levels. And then going forward, every year kind of shave 1 or 2% of the combined ratio, depending on the book that you write and depending on the catastrophic losses that come in the market. Uh, but again, I mean, when I look at it, we look at it things slightly differently. While your point is well taken that the combined ratio has to come down below 100 to actually make money from the operations, we also tend to look at the income that we earn on the policyholders' funds that are available with us because we are writing this business. So when we add that income back to the business that we are writing, then actually our combined today comes to almost 89%.
Okay. When you say that you had impact because of floods and other issues, aren't they part of every year's assumptions? Because flood and operational related problems in property happens every year. Sometimes it's Chennai, sometimes it's Delhi, sometimes it's Mumbai, sometimes it's both. So what was so unique about this time?
So this time it's actually been good. So as I mentioned earlier, last year for the same period, our combined was close to 118%. Today it is 111. So we have actually done better. But why I'm bringing this point is normally these two quarters, the September quarter and the December quarter, you would normally see the combines slightly higher than where it would settle at the end of the year because the premiums have not fully come in. We are providing fully for the losses. We don't provide, only a part of the losses. We provide fully. So this year there have been a few events. Comparatively, the severity has been low in India, but abroad, if you look at it, especially at the end of September and early October, we had two events, Helene and Milton. So we have provided for that. But hopefully in the third quarter, we'll get some releases there because Milton at the initial stages it looked like a market loss of $50 billion. But now when we talk to people concerned connected with the event, we get a feeling that it could kind of settle between 20 and 24 billion. So to that extent, the next quarter we might get some release from our provisioning as well.
We believe that reinsurance renewals as well are going to begin next year, with major insurers now reporting rising pressure and profitability. Tell me, do you think renewals will add up some pressure on your margins as well?
So there are two renewals happening. One is, of course, the immediate one is the first Jan renewals, which happen internationally. And that is something that we are looking at very carefully because I have said this earlier. For doing good international business, you need a good credit rating, international credit rating. And we have been working towards that for the last couple of years. And it's very gratifying that in October, AM Best revised our credit rating upwards to A minus excellent with a stable outlook. Now that gives us a good chance to grow our international book, write some very good profitable international business. It will add to our diversification, give us the kind of spread that we are looking for as a reinsurer. So we have already in touch with some of our clients, to ensure that the business that we lost when our credit rating got downgraded, we are able to win that back. So we are very confident about getting that. And then, of course, the 1st April renewals for the Indian market. You are right. With the way the market is performing and some of the pricing that we see on the direct side, there could be challenges in the reinsurance. Whether it will actually get into a margin game for us, we will see that as we go along. There is also a possibility that some of the capacities may not be available for some businesses which are not doing well. So this is something that we are discussing with the market. We are totally engaged with the Indian market to ensure that both the insurers and reinsurers are on the same page when it comes to the business that we are seeing currently.
Where is the market share moving? Every time when we speak to a PSU insurer company, the first question is, oh, competition from the private folks is increasing. Where are you in terms of market share, and how are you planning to protect it or even increase it?
Yeah, so currently, if you see the Indian market, we possibly have about close to 55 to 60% of the Indian market, right? And this will continue going forward as well, because we do write quite big shares in our market. There could be some pressures of competition happening. There are already foreign reinsurance branches which are currently operating in this market. There are a lot of cross-border reinsurers also working in this market who do not have a presence in this market physically, but then they do write a lot of business. Close to 30% is written by them. Now, of course, there are a few things that is happening, and we will be looking at it very closely to see how that affects our market. For instance, the regulator has already come out with regulations saying that cross-border reinsurers need to put in a collateral for writing business in this market. So basically, that could mean two things. It could mean that some of the bigger cross-border reinsurers who are writing decent shares in this market may decide to open up operations onshore in India. Or it could also mean that some of the smaller cross-border reinsurers stop writing business because they don't want to put in the necessary collaterals. So we are looking into that, and we'll see how best to support the market. At the end of the day, the important thing is that the market continues to be, continues to grow the way it is growing. But at the same time, the viability is there in the market for both players, whether it is insurance companies or reinsurers. The business that we are doing and the pricing that we are doing, it must be viable for us to continue on the long term.
Right. Okay. So great having you on the show today and highlighting how your earnings have been. Good to speak with you.
Thank you. Thanks a lot. Thank you for having me.
If you like this video, then like, share and subscribe to ET Now.